Did you know that Tesla, one of the most revolutionary companies of our time, is trading at a discount? While some analysts dismiss it as overvalued, there's a growing argument that Wall Street is missing the real story. With Tesla advancing beyond just cars into AI, energy, and autonomous tech, could its stock be one of the biggest overlooked opportunities of 2024? Stay tuned to find out why Tesla might be undervalued right now, and how this might be your chance to get in on the ground floor of something huge. Tesla's potential might just be one of the most misunderstood stories on Wall Street right now. Sure, everyone knows it's a leader in electric vehicles, but few realize just how much more the company has going for it. Tesla isn't really an automaker. It's a tech powerhouse operating at the intersection of clean energy, artificial intelligence, and transportation innovation. This is a company that's investing heavily in areas that could shape the future of multiple industries, yet its current valuation doesn't fully reflect this transformative potential. Consider the scale of Tesla's influence. It has set the standard for EVs, prompting legacy automakers to rush their own electric models to market. But beyond vehicles, Tesla's technology extends into energy storage, solar solutions, and even autonomous driving software. And unlike most companies in the automotive sector, Tesla owns its supply chain, from battery production to the software powering its full self-driving technology. This gives it a unique advantage in scaling its innovations without reliance on external suppliers. Tesla's full self-driving (FSD) software is a prime example of this undervalued potential. While traditional valuation methods might overlook the impact of software, SSD subscriptions alone could generate billions in annual revenue as adoption increases. Imagine a future where Tesla vehicles not only transport passengers but also generate recurring income for the company from these high-margin software features. With the adoption rate for SSD already above expectations, Tesla's software model could significantly boost its long-term value in ways that traditional automakers could only dream of. And as Tesla scales production, each new development feeds into a grander vision. Tesla's investments in its gigafactories aren't just about building cars faster. They're about creating hubs for innovation in renewable energy and storage. In a world increasingly focused on sustainable solutions, Tesla's energy products, like Powerwall and Megapack, are more than just side projects. They're a critical part of the future Tesla is building. So, while many investors see Tesla stock through the lens of its current PE ratio or recent stock price volatility, it might be missing the bigger picture. Could Tesla's diverse growth potential actually make it undervalued in the eyes of traditional metrics? With each innovation Tesla brings to market, the gap between its stock price and its true value could become more apparent. The question is, how long will Wall Street continue to overlook Tesla's transformative potential? Now, let's talk about one of the most debated aspects of Tesla's stock, its price-to-earnings (PE) ratio. On paper, Tesla's PE ratio looks sky-high, far above the average for the S&P 500. For some investors, this alone is a red flag, suggesting that Tesla's stock is wildly overvalued. But here's the catch. Traditional metrics like PE ratios may not tell the full story for a company like Tesla, one that's breaking the mold of what an automaker can be. A quick breakdown shows why this is the case. The S&P 500's PE ratio sits at around 33.9, while Tesla's current PE ratio is a jaw-dropping 406.6. At first glance, this seems out of alignment with the broader market, and understandably, it gives some investors pause. But there's a critical factor here. Tesla isn't simply a car manufacturer. In fact, a growing segment of Tesla's revenue comes from software, energy storage, and renewable energy products. Unlike traditional car makers, Tesla operates as a tech company and an energy company rolled into one, blending multiple high-growth sectors that have the potential to generate diverse and substantial revenue streams. Furthermore, looking only at the PE ratio ignores Tesla's trajectory. Tesla has only recently achieved consistent profitability, which means it lacks the historical earnings that would lower its PE ratio in the way that more established companies do. Instead of focusing on this metric alone, investors should consider Tesla's earnings growth potential. In industries with transformative potential like AI, autonomous driving, and renewable energy, a high PE ratio often indicates investor confidence in rapid, sustained growth. And Tesla's forward-looking earnings growth could justify this higher valuation, especially as its market share and product portfolio continue to expand. Traditional automakers like Ford and GM don't command these kinds of valuations because their revenue models don't have the same tech-forward, high-margin opportunities as Tesla. Tesla's advanced self-driving software, full self-driving (FSD), is a perfect example. As adoption of FSD grows, Tesla's software subscription model has the potential to generate billions in recurring revenue, which doesn't rely on physical car sales alone. This high-margin revenue stream can further drive Tesla's profitability in ways a typical PE ratio might not account for. So you consider Tesla's P ratio. Remember that it's only one piece of the puzzle. The standard metrics might not apply to a company that's pushing the boundaries of multiple industries at once. This higher than usual P ratio isn't necessarily a warning sign. It could actually be a signal of Tesla's long-term transformative potential. Are investors who focus only on traditional metrics overlooking Tesla's true value? Tesla's future value lies in far more than just its electric vehicles. In fact, one of Tesla's most underestimated strengths is its ability to diversify across multiple high-growth industries, including energy storage, solar power, and autonomous software. Tesla isn't just building cars, it's creating an ecosystem that could revolutionize how we generate, store, and use energy. Take energy storage, for example. Tesla's Powerwall and Megapack products are transforming how we think about energy independence and grid reliability. The demand for these products is soaring, especially as governments and corporations push for cleaner energy solutions. Tesla's energy storage solutions allow homes, businesses, and even entire regions to store renewable energy for later use, providing stability and reliability in ways traditional energy grids can't. In places where renewable energy is becoming the norm, like California, Texas, and parts of Europe, Tesla's energy storage products are positioned to be critical components of the infrastructure of the future. And with Tesla's target of 75% year-over-year growth in this segment, we could see energy storage becoming a substantial part of Tesla's revenue in the coming years. Then there's solar energy. Tesla's solar roof may have taken longer to scale than initially planned, but it represents another massive opportunity. Unlike conventional solar panels, Tesla's solar roof integrates into a building structure, turning the entire roof into a power-generating system. While still in its early stages, this technology aligns perfectly with the global shift towards sustainable energy solutions. The demand for renewable energy continues to rise, and with it, the potential market for Tesla's solar and energy storage products is enormous. If Tesla can further lower production costs and scale its solar roof installations, it could secure a significant market share in the renewable energy space. Finally, consider Tesla's full self-driving FSD software. As more Tesla owners opt for SFD subscriptions, Tesla is building a new high-margin revenue stream that traditional automakers can't replicate. While competitors like Waymo and Cruise are also investing in autonomous technology, Tesla's approach is different. Instead of launching a separate fleet, Tesla is embedding FSD technology into its existing vehicles, creating an autonomous network on the go. This means Tesla doesn't just sell cars, it's potentially creating a fleet of robotaxis in the making, with revenue streams from SFD that could reach billions in the near future. In essence, Tesla's potential lies in its ability to operate across different sectors, each with massive growth potential. Unlike traditional automakers, Tesla's energy storage, solar, and autonomous software segments each have the capacity to become billion-dollar businesses on their own. Could it be that the market is overlooking these diversified growth engines in Tesla's valuation? As Tesla builds out this ecosystem, it's not just competing in the automotive industry, it's creating a blueprint for the future of clean energy and autonomous technology. Let's dive into Tesla's role in the global electric vehicle (EV) market and why its edge over competitors goes deeper than just being an early mover. Tesla didn't just start the EV race, it has defined the standards that other automakers now scramble to meet. But what many people miss is the breadth of Tesla's innovation and the massive infrastructure it has built to stay far ahead of the competition. This is not only about market share, but about Tesla's dominance in technology, scale, and production efficiency. Tesla's gigafactories around the world are a prime example of this competitive advantage. These massive factories don't just assemble cars, they manufacture critical components like batteries, often referred to as the heart of EVs, on-site. Tesla's focus on vertical integration means that it controls more of its supply chain than traditional automakers, giving it greater resilience to disruptions and a much stronger handle on costs. While other companies rely on third-party suppliers for their batteries and other essential EV components, Tesla's gigafactories allow it to innovate directly within its supply chain, leading to improvements in battery efficiency, range, and production speed. This infrastructure positions Tesla to expand rapidly, while competitors face bottlenecks due to their dependence on suppliers. Then there's the technology itself. Tesla's vehicles come equipped with one of the most advanced software systems on the market, with regular over-the-air updates that continually improve performance, safety, and driver experience. This focus on software innovation gives Tesla a huge edge over traditional automakers whose cars typically require physical upgrades or visits to a service center to receive new features. Tesla's ability to push updates remotely keeps its vehicles cutting edge and increases their longevity, providing added value to customers and reinforcing brand loyalty. This software advantage is something other automakers are only beginning to explore, but Tesla has been perfecting it for years. Tesla also stands out for its brand strength and customer loyalty. In the EV space, the brand has become almost synonymous with innovation and sustainability, attracting not just car buyers, but an entire community of supporters who believe in Tesla's mission of accelerating the world's transition to sustainable energy. This brand loyalty gives Tesla an intangible, yet very real, advantage in the market. People don't just buy a Tesla for the car itself, they buy into the vision that Tesla represents. And with competitors like BYD and legacy automakers struggling to match Tesla's brand strength, Tesla's ability to command a loyal and growing customer base remains unparalleled. While traditional automakers are still navigating the transition to EVs, Tesla's infrastructure, technology, and brand loyalty provide it with a well-established lead. As the global EV market continues to grow, Tesla's foothold means it's not just keeping up with demand, but actively shaping it. This entrenched position gives Tesla a competitive moat that's hard for other companies to cross, and it raises the question: could the market be undervaluing Tesla's role as a dominant force in a future where electric vehicles will likely be the standard? As competitors try to catch up, Tesla's innovation and scale may keep it well ahead, reinforcing its potential as a long-term winner in the EV industry. Tesla's roadmap for affordable electric vehicles is set to be a game changer, not just for the company, but for the entire EV market. Imagine a Tesla that's accessible to the average consumer. This is what Elon Musk is planning with Tesla's upcoming affordable vehicle, expected to hit the market by 2025. The potential here is massive, as this shift could open up Tesla's brand to millions of new customers who previously found the price point just out of reach. With an affordable model, Tesla could dramatically increase its market share and secure a dominant position in the mainstream automotive market. Affordability has long been a barrier in the EV market, with many consumers seeing electric vehicles as premium products. But Tesla's goal to make a high-quality, low-cost EV could break down this barrier, making EVs accessible to a much wider audience. Not only does this align with Tesla's mission of sustainable energy for all, but it also positions the company to capture an enormous segment of the market that's been largely untapped. By pricing an EV in a range that competes directly with traditional gas-powered vehicles, Tesla could spark a shift in consumer expectations, normalizing EV ownership for everyday drivers. This strategy also aligns with Tesla's broader approach to cost efficiency. Through its vertically integrated production model and continuous innovations in battery technology, Tesla has been able to reduce production costs over time. The development of its new 4680 battery cells, which are more efficient and cheaper to produce, is a crucial step toward making affordable EVs a reality. These advancements in battery technology could allow Tesla to cut costs further, potentially lowering the price of their cars without compromising quality or range. Moreover, Tesla's affordable model isn't just about capturing new customers, it's also about creating a future-proof brand. As more countries implement policies to phase out gas-powered cars, the demand for affordable EVs will only grow. By establishing a strong presence in this segment early on, Tesla can ensure that it remains a market leader even as the automotive landscape transforms. This isn't just about selling more cars, it's about securing Tesla's position as a cornerstone of the sustainable energy revolution. Tesla's plan for an affordable EV could be one of the most impactful moves the company has made. It's a strategy that could redefine the company's reach, driving millions more to switch to electric vehicles and helping Tesla solidify its lead in the global market. If successful, this strategy will make it difficult for competitors to catch up, positioning Tesla as a brand that can meet the needs of a broader audience and putting it one step closer to its mission, a sustainable electric future. Could this bold move to offer affordable EVs be the catalyst that shifts Tesla from a luxury EV brand to the mainstream choice for millions? While Tesla's innovations and ambitions are undeniably impressive, the company also faces significant criticisms and challenges, especially regarding its high valuation. Tesla's forward price-to-earnings ratio is several times higher than the industry average, and for some investors, this is a glaring red flag. Traditional metrics like the PE ratio, price-to-sales ratio, and price-to-earnings growth ratio, PEG, indicate that Tesla's stock is priced at a premium, often leading critics to argue that the market is placing unrealistic expectations on Tesla's future growth. But here's where it gets interesting. Could these same criticisms be overlooking the unique potential that Tesla brings to the table? Tesla's valuation is indeed ambitious, and its goals, like autonomous robotaxis and humanoid robots, are equally bold. These initiatives carry high risks, and while they have the potential to generate massive revenue streams, they also come with uncertainties. The robotaxi vision, for instance, has been delayed multiple times, and regulatory hurdles continue to present significant barriers. Tesla's Optimus humanoid robot is still in its early stages, facing years, if not a decade, of development before it becomes commercially viable. Critics argue that Tesla's focus on these high-stakes projects might distract from its core business and that such ambitious ventures could lead to volatility in Tesla's stock if they don't materialize as planned. Yet, while these criticisms are valid, they also underscore just how different Tesla is from traditional automakers. Tesla's high valuation isn't based solely on its current vehicle sales or immediate earnings. It's rooted in the transformative potential that these forward-looking projects hold. Tesla isn't just aiming to sell more cars, it's aiming to redefine personal and commercial transportation with autonomous technology, create entirely new consumer markets with its robotics division, and pioneer advancements in energy storage that could benefit industries far beyond the automotive sector. This level of ambition is rare, and it's why Tesla is often viewed as more than a car company. Investors are betting not just on the Tesla of today, but on the Tesla that could shape multiple industries tomorrow. However, it's true that these future-focused projects add layers of complexity and risk, and they highlight the balancing act Tesla faces between visionary projects and sustainable growth. Tesla's valuation reflects the market's belief in its ability to achieve groundbreaking advancements, but this faith requires constant innovation and execution with little room for failure. So, is Tesla's valuation a warning sign of overhyped ambitions, or is it simply a reflection of the company's far-reaching potential? As investors debate this question, Tesla's unique position as both an automaker and a tech innovator keeps the conversation going. Could it be that traditional metrics don't fully capture the value of a company with such a disruptive vision? And if Tesla succeeds in even a fraction of its bold initiatives, would today's valuation seem like a bargain in hindsight? Elon Musk's role in Tesla's journey is both a major asset and a potential risk, influencing not just the company's vision, but also its stock's volatility. Musk isn't just the CEO, he's the face, the voice, and to many, a genius driving Tesla's ambitious goals. His bold predictions, relentless focus on innovation, and willingness to take risks have made Tesla what it is today. But Musk's leadership style and his outspoken personality add a unique dynamic to the company's valuation and market perception, leaving investors to weigh the benefits of his visionary approach against the potential downsides of his unpredictable influence. Musk has a reputation for making grand promises, from his predictions on Tesla's full self-driving capabilities to the launch of the Optimus robot. While this confidence in Tesla's future has fueled enormous excitement and investor interest, it has also attracted criticism. Musk has often set aggressive timelines that the company has struggled to meet, leading some to question the feasibility of his goals. Take the robotaxi project, for instance. Musk has promised a fleet of autonomous taxis by 2027, but regulatory and technological hurdles could delay this vision. His track record of ambitious claims means that investors sometimes find themselves on a roller coaster, with Tesla's stock price fluctuating based on Musk's latest tweets or public statements. Yet there's no denying the impact of Musk's visionary approach. He's been instrumental in making Tesla the leader in EVs and has set the company apart from traditional automakers. Investors who believe in Musk's vision see his bold statements as part of the bigger picture, a calculated risk that's driven Tesla to dominate the electric vehicle and renewable energy markets. His leadership has instilled a culture of innovation within Tesla, pushing boundaries in a way that few companies can match. This blend of audacious goals and relentless pursuit has created a brand loyalty that goes beyond products, rallying supporters who believe in Musk's mission to accelerate the world's transition to sustainable energy. However, with Musk's vision comes volatility. His outspoken nature and involvement in other ventures like SpaceX and Neuralink mean that investors are often left wondering where his focus lies. As Tesla continues to scale and tackle ambitious projects, the stability of Musk's leadership is a crucial factor for its future. Investors must weigh the potential for groundbreaking innovations against the inherent unpredictability of Musk's influence. Could his unique leadership be the very factor that makes Tesla a long-term success, or might it lead to challenges as the company grows and faces increasing competition? Musk's leadership brings both incredible potential and undeniable risk to Tesla's future. His commitment to innovation has placed Tesla on a path few other companies could replicate, but his style also poses questions for investors. Will Musk's daring vision continue to push Tesla forward, or could his unpredictable approach prove challenging in the long run? In many ways, Musk's influence on Tesla's stock is as much a driver as the company's actual performance, making it one of the most intriguing aspects of investing in Tesla today. As Tesla marches forward, it's crucial to consider the external factors that could impact its growth, especially the evolving policy landscape and the upcoming U.S. presidential election. Government policies have a substantial influence on the EV market, from tax credits and subsidies to import tariffs and environmental regulations. With Tesla's global operations and ambitious plans, shifts in policy can either accelerate or impede its progress, making this a factor every investor should keep an eye on. In the United States, the outcome of the 2024 presidential election could significantly shape the EV industry. If a pro-EV administration remains in power, we could see increased support for electric vehicle incentives, possibly making Tesla's products more affordable for a broader audience. Federal tax credits could expand, charging infrastructure could receive more funding, and additional support might emerge for renewable energy projects, aligning perfectly with Tesla's mission and products. For Tesla, these kinds of policies are like a tailwind, providing added momentum as the company scales its affordable vehicle line and expands its energy division. However, the potential for a shift in administration brings uncertainties. A government less inclined to prioritize renewable energy might cut back on EV incentives or introduce policies that could slow down Tesla's growth. For instance, trade policies that increase tariffs on imported materials could impact Tesla's supply chain costs, especially considering its reliance on international suppliers for certain components. Additionally, stringent regulations on autonomous vehicles could delay Tesla's robotaxi ambitions, as each market Tesla enters may have different requirements for self-driving technology. On the international front, Tesla's expansion into markets like China and Europe introduces additional policy considerations. In China, for instance, Tesla has successfully established a gigafactory and gained a significant foothold, but it faces the ongoing risk of tariffs and other trade restrictions, especially if tensions between the US and China rise. Conversely, Europe's aggressive climate policies align well with Tesla's goals, and continued support for clean energy could fuel Tesla's market share in key regions. However, as competitors in these markets ramp up their EV offerings, Tesla will need to adapt to both local consumer preferences and evolving regulations to maintain its edge. While Tesla's innovations and market strategy are strong, its trajectory is closely tied to policy decisions that are outside its control. For investors, this means that understanding the potential impacts of government actions is crucial to assessing Tesla's future value. Will supportive policies enable Tesla to achieve its ambitious growth, or could regulatory hurdles and policy shifts prove to be obstacles? As Tesla navigates these external forces, the company's resilience and adaptability will be tested, and these factors could shape its valuation just as much as its next big innovation. Tesla's future is a tapestry of innovation, risk, and unprecedented growth potential. Throughout this journey, we've seen how Tesla's undervalued aspects extend beyond mere vehicle sales, encompassing energy storage, autonomous driving, and a bold push toward affordable EVs for the masses. But the big question remains, does Tesla's current stock price truly reflect its transformative potential, or is Wall Street missing the mark? Tesla's diversified approach, spanning high-margin software, scalable energy solutions, and a disruptive vision for autonomous transport, sets it apart from any traditional automaker. Critics may point to Tesla's high valuation ratios, yet these metrics often overlook the multifaceted revenue streams and technological advancements that Tesla is pioneering. As the EV market grows and Tesla's affordable vehicle becomes a reality, the company is positioning itself to dominate on a global scale in ways that competitors may find difficult to match. And with Elon Musk at the helm, Tesla's trajectory is driven by a relentless focus on innovation that appeals to a loyal consumer base and investor community. Despite the volatility his leadership may introduce, Musk's vision is undeniably a key factor in Tesla's evolution from a luxury EV maker to a potential mainstream giant in sustainable energy and autonomous tech. As we've discussed, Tesla's growth isn't just speculative, it's rooted in real, game-changing products and a commitment to technological leadership. For investors, the opportunity here could be monumental. If Tesla continues executing its ambitious roadmap, the stock's current price may indeed prove to be a discount in hindsight, opening the door for long-term value beyond what traditional metrics suggest. So, could Tesla's stock today beat the chance of a lifetime? Only time will tell if Tesla's journey will redefine what it means to be an industry leader. But for now, the company stands poised at the intersection of innovation and opportunity, ready to reshape the future of multiple industries. If you want to stay on top of this transformative journey, subscribe to our channel for the latest insights and updates. And remember, while Tesla presents a unique investment narrative, always consult with a financial advisor for personalized advice.